M. Understand the interrelationship of variables affecting option value. Option value depends on several variables: underlying asset price, strike price, time to expiration, volatility, risk-free rate, and dividends. Changes in these factors directly influence premium value. For call options, higher underlying prices increase value. Conversely, higher strike prices decrease call value but increase put value. Greater volatility increases both call and put premiums. Higher uncertainty raises the probability of favorable price movements. Longer time to expiration generally increases option value. More time allows greater opportunity for price movement. Interest rates also affect value. Rising rates typically increase call values and reduce put values, reflecting the time value of money. N. Define interest rate and foreign currency swaps. An interest rate swap is a contractual agreement between two parties to exchange interest payment obligations. Typically, one party pays a fixed rate while receiving a variable rate, or vice versa, based on a notional principal amount. Swaps are used to manage interest rate risk. Firms can convert floating rate debt to fixed rate exposure, or the reverse, aligning financing costs with strategic objectives. That a foreign currency swap involves exchanging principal and interest payments in different currencies. It helps manage foreign exchange risk associated with international operations or financing. Swaps are over-the-counter agreements and involve counterparty risk. They are strategic tools for reducing volatility in cash flows and financing costs. O. Define and identify characteristics of other long-term financing sources. Leases provide the right to use an asset in exchange for periodic payments. They allow firms to access assets without large upfront capital investment and may offer tax or balance sheet advantages depending on accounting treatment. Convertible securities are bonds or preferred shares that can be converted into common stock. They offer lower interest costs in exchange for potential equity dilution. Warrants are long-term options issued by a company that give holders the right to purchase shares at a specified price. They are often attached to bonds to make them more attractive. These financing sources balance cost, flexibility, and dilution considerations. Understanding their features supports effective capital structure management. P. Demonstrate understanding of the relationship among inflation, interest rates, and prices of financial instruments. Inflation and interest rates are closely linked through the Fisher effect. Nominal interest rates incorporate expected inflation, plus a real rate of return. When inflation expectations rise, lenders demand higher nominal rates to preserve purchasing power. Higher interest rates reduce the present value of future cash flows. As discount rates increase, bond prices fall and equity valuations may decline due to lower present values. Fixed income instruments are particularly sensitive to inflation. Unexpected inflation erodes the real value of fixed coupon payments, decreasing bond attractiveness. Equities may partially hedge inflation over time. Companies can sometimes pass higher costs to customers, though short-term volatility may occur. Understanding this relationship supports effective investment, financing, and risk management decisions. Q. Define the cost of capital and explain its role in capital structure decisions. The cost of capital represents the required return investors demand for providing funds to the company. It reflects the opportunity cost of investing capital in a specific business, given its risk profile. It serves as the discount rate in capital budgeting decisions. Projects must generate returns greater than the cost of capital to create shareholder value. Cost of capital includes both debt and equity components. Each component reflects different risk levels and contractual obligations. Capital structure decisions influence overall cost of capital. Increasing debt may lower costs due to tax benefits, but increases financial risk. An optimal capital structure balances risk and return to minimize overall cost of capital and maximize firm value. R. Determine WACC and the cost of its individual components. Weighted average cost of capital, WACC, represents the blended required return on all sources of financing. It is calculated by weighting the cost of debt, preferred stock, and equity by their market value proportions. Cost of debt equals the after-tax interest rate. The tax shield reduces the effective cost since interest is tax-deductible. Cost of equity may be estimated using CAPM or dividend growth models. It reflects compensation required for systematic risk. Preferred stock cost equals dividend divided by market price. WACC is used as the hurdle rate in evaluating investment projects and corporate valuation.